Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network, CREPN Radio. We're so glad you joined us. My name is J. Darren Gross. I'm a real estate investor and a commercial property insurance broker. Since my first investment in real estate almost 20 years ago, I've constantly been looking for more information about real estate investing for my own investments and also so that I could better serve my clients. The result of these efforts have led me to create Commercial Real Estate Pro Network and CREPN Radio. CREPN Radio is my effort to create a network of professionals where we can have and share a conversation with experts on topics of interest to investors and professionals dealing in commercial real estate. Bottom line is we're trying to help investors in commercial real estate. If you're listening to us, you probably found us through the LinkedIn invite. The show is hosted on Blog Talk Radio, but I want you to know you can Google Commercial Real Estate Pro Network, and from there you should be able to find us on Facebook, YouTube. We have a LinkedIn group, like I mentioned, and we also have a Twitter handle. Twitter handle is at CRE Pro Network. Also, we are going to have a website here shortly. The website URL will be commercialrealestatepronetwork.com. Now, how you can help us. If you like what you hear, if you like what our guests are saying, if you like any of the free materials the guests are providing, give us a comment, like, a follow. Tell your network about us, because that's social media about us. It's time to our David Fantin, and the topic is 6 mistakes that investment real estate buyers make and how to avoid them. The topic's universal for investing in real estate. It'll apply to multifamily, retail, office, single family, etc. And a little bit about David. David is a real estate advisor. He's an entrepreneur and an investor. He's a national commercial real estate consultant. He's a acquisitions expert broker. He's also the CEO and president of Intero Realty Assets and Intero Realty Advisors. He's invested in over 818 units, commercial properties, and residential investment real estate. I'm going to ask him to tell us a little bit about Intero Realty Assets versus Intero Realty Advisors, and also he is a broker in Texas, Maryland, and Florida. With that, I'd like to welcome our guest, David. David, are you there?
Sure am. Thanks for having me, Darren.
Hey, I'm glad you could make it.
Same here. It's a beautiful day here in Houston, mid-80s already. I think we just kind of went right from winter into summertime, but it is what it is.
No kidding. It has been a wacky year. I know out here on the West Coast we have definitely been seeing summer-like, spring-like conditions, and now a little bit. Actually, we're having a little bit of the reverse. We've gotten all of a sudden kind of a little bit of cold, wet spell. I noticed there was a little bit of snow up on the mountain the other day. But anyway, can't control that. That's the weather, and don't know what else we can do about that. But hey, before we jump in here, you mentioned that you are in Houston, and I don't know if this is the right time to do it or not, but I just wanted to bring up, I've been reading about Houston here for probably about the last 6 months. And I want to say 6 months ago, everything I was reading about was it's a boom town. There's construction all over. There's cranes in the air. There's just huge demand. And I think that was in multiple articles about this boom town. And then I think I guess it was the oil price per barrel has plummeted. And I know I like that at the pump, but I'm sensing that Houston is uniquely, how should we say, affected by that? Are you seeing, and again, I'm picking up on different signals, like maybe there's a change in the air, or there's can you describe them?
Great question, Darren. And, I read the same things that you do. Obviously you're located in Portland, Oregon. I'm here in Houston, Texas. And there's two things that you have to look at, right? You have to look at who's saying what at what time, and then you got to drill down and look at Houston. Houston is a big place. If you look at Houston Metro, we're about 5.5 million people. 3 hours to our north is Dallas, Fort Worth area. That's another 6 million people. Another part I think you have to look at is, a lot of people think of Houston as an oil and gas town. And maybe that was more the case, if you will, back in the 80s, just prior to that bust that they had here, and I wasn't here back then. But we're a lot different these days. In other words, we're not just oil and gas, we're energy. Not only that, we have one of the largest shipping ports in the country, if not in the world, and our shipping port is doing fantastic. What else is going on in Houston? We have the second largest theater for the arts just outside of New York City. We have tourism. We have no state income tax in the state of Texas. We have been leading the country in generation of new jobs for I don't know how many years now. And we also offer incentives for companies to move here to do business because the lower cost of living. So again, I read the same things you read, and I'm reading this, and it sounds like gloom and doom, and the Grim Reaper's coming to take us all away. But when you dig down a little deeper and you really, really peel back the layers of the onion, things are not bad here. Things are actually still going well. Are things going to change down the road? Probably so. Are some sectors going to be affected in the economy, or let's talk, it's a show about commercial real estate. Are some of those sectors in real estate going to be affected? Sure, absolutely. But there are going to be others that are not going to be affected. And even in some of the sectors, depending on the class of property, whether it's a Class A property or a Class C or D property, is going to make a difference inside of that sector too. So I drive around town here, Darren, and I live, my residence with my family's here in the Woodlands, Texas. So we're a northern suburb bedroom community, about 80, 90,000, going to about 140,000. Cranes in the air everywhere. They're building apartments. They're building retail. They're building office buildings. If I go down into Houston, I see the cranes up everywhere there too, and they're building and building and building. Land prices have hit the highest they've hit in years. A lot of these vacant parcels are now being developed. So these projects are moving along. What's going to happen 6 months from now, a year from now, 2 years from now? I wish I had that wonderful crystal ball, because probably if I did, I wouldn't be talking to you. I'd be sitting on an island I own in Tahiti. But,
Right.
The point being is that we have our spin doctors and we have this negativity. You have to drill down and really, as I said earlier, peel the onion back. What's really going on? And you have to talk to some of the folks that are out there. As an example, a couple months ago, I went to one of the CCIM meetings, and it's one of the commercial institutes that I belong to as a real estate broker. And there's a gentleman by the name of Mark Dotzer, Dr. Mark Dotzer. He heads up the Real Estate Center for Texas A&M. Very smart guy. And every year he gives his outlook on the economy as it relates to real estate when he comes to talk to us. And there's hundreds of us in the room anxiously waiting to hear what he has to say. And I'm thinking, too, based on everything that I read, just like you read and others, wow, Dr. Doxauer is going to really paint this horrible picture. And it was quite the opposite. He said that interest rates are going to remain low. Look at the 10-year Treasury compared to 10-year Treasury rates around the world. They're going to stay low because we're one of the highest Treasury bills in the world. As you know, Darren, 10-year Treasuries are tied, or commercial interest rates are tied for real estate properties to the 10-year Treasury. He believes they're going to be pretty much unaffected for the next couple of years, which means there will be financing and lending at these interest rates in the 4s and 5s out there. Look at retail. I thought retail might get hurt by some of this. On the contrary, I read some of these articles that have come out in the last month or so. The Greater Houston Partnership, they had 3 economists, and all 3 economists said that the market's going to look good, that actually lower gas prices is going to be good for the consumer, which means they have more money in their pocket, which means they'll go out and spend money at that Subway store, at that other retail store that may be out there, at the dry cleaners, et cetera, et cetera. So retail may not be so affected as well. The two areas that I'm concerned about, based on what I'm reading, is office, which would be Class A office, and industrial, because apparently there's about 8 million square feet that are going to be coming online in the industrial space being built with absorption of about 6 or 7 million. So we're going to have a negative absorption, which means you're probably going to see rents fall a little bit in industrial. And the office buildings, too, they seem to be maybe an oversupply there, too, where there might be some issues. But the rest of the economy, the rest of the other sectors seem to be doing just fine.
Well, I really appreciate your insight because, like you said, if you read something and not being there local enough to be able to, kind of see it from my own eyes or know local people that I can actually ask the question, it's, it can paint a pretty, I don't want to say bleak, but just it paints a picture of like, what's going to happen kind of thing. And I think you mentioned the reference back to the 80s. It was kind of the one thing that I've read that, and I don't know exactly what was in play there, but clearly whatever it was, it made a significant impression on the marketplace. And I don't know if there's some residual kind of memory of that, and wondering, is it going to happen again, kind of thing. But and the other thing I was going to say is that everything I've ever read about Texas, and the few times I've been to Texas, it's its own unique economy. I mean, you said just between Houston and Dallas, there's 10 million. Is that 10 million between the two metro areas?
Right. There's about 5.5 million here, and more than 6 million up in Dallas, which is only about a 3-hour drive from my home.
So, 11 million people, and just a very, very pro-business climate is everything that I've always heard about. And the other thing too, you mentioned the port. I know being out here in Portland, there was a West Coast longshoreman strike, or not a strike, but there was a labor negotiation thing, and it lasted for a while. And I forget the shipping company, but they actually pulled out of Portland here. So it's to have a healthy port is a huge thing to really stabilize an economy and give you another source of jobs and that. So that's good news. I'm glad to hear that, and thank you for providing a little light on the Houston marketplace there.
Sure thing.
And if we can just back up 1 second, because I didn't mean to interrupt this, but in your bio there, I was reading a little bit about your two companies. You've got Intero Realty Assets, and then you've also got Intero Realty Advisors. Can you tell the listeners a little bit about each one of those and how they're different? Sure.
Intero Realty Assets is a company that I wholly own, and what we provide is the potential for investors to partner in opportunities that I bring to the table to potentially achieve double-digit returns and appreciation through commercial real estate investments. And right now I'm kind of keying on retail. This is something, Darren, which I would say that's ideally suited for the hands-off investor, the person who has their job. They may like their job, love their job, maybe even they hate their job, but every day they go to work. So they can't be out looking for real estate, buying real estate. So they're looking for alternatives possibly, or in addition to the stock market. They're going to be hands-off. They're looking to put their money to work. Well, Intero Realty Assets through Realty Income Shares, we provide those opportunities to those hands-off investors that can partner in some of these opportunities that I bring to the table. Intero Realty Advisors does consulting. We have some folks out there that want to be active or hands-on real estate owners and hands-on real estate investors. And I provide on a national basis consulting to those folks to help them with those real estate opportunities in commercial real estate that they're looking for as well. And I'm also a broker in several different states, and I work through Intero Realty Advisors to consult, advise, and represent those hands-on investors.
Great. Well, thank you for clarifying that. I read that, and clearly you've got a couple different platforms there and able to serve depending on what your client's interests are in commercial real estate. That's great. So let's roll up our sleeves here a little bit, and let's get into the main course here, the topic, the 6 mistakes that investment real estate buyers make and how to avoid them. So with that, there's the number is 6. I'm going to ask you, what do you see as the number one problem that real estate buyers make?
Sure. Number one is not buying right. And Darren, this actually ties into the next 5 and the remainder of the show. We're going to talk about all of these because the next 5 really dovetail into not buying right. Now, keep in mind that there are externalities beyond our control. There could be a major shift in the market, or interest rates could jump from 4 to 8%, and that can make a big difference when you're looking to buy a deal. Or if you already own an opportunity, there may be some things that happen in the market that could hurt you. Vacancy could arise out of that, or you no longer can get the rents that you had once thought you can get. But outside of that, you need to buy right, which means you need to know the numbers, the forecast. You have to get your arms around that budget. You need to make sure that you go out and rehab the opportunity and add value if that's what you're going to do. Develop a business plan and execute. But I really believe that you have to buy right. And if you don't buy right, things can happen. In other words, we can be in a pretty robust economy in certain parts of the country, such as Houston has been a robust economy here for many years. We did get hit a little bit in 2008 and 9 and 10, just like some other folks, but we've rebounded. But here's the thing. We may not always be where we are. There could be a setback. There could be a drawback. But again, it's number one is not buying right. And as we talk about the next 5, the listeners will see how those 5 really always go back to the number one, which is not buying right.
Right. No, I've been guilty of not buying right. And, I remember the first one I bought, keep thinking that it was going to right itself, and never did, but I ended up making a little bit of profit on the sale there. But it was, like you said, if you're not buying right, and just even knowing the numbers, is there a specific, I mean, in the numbers are the, well, let's go on to continue through here because I think it'll all kind of feed back to this. So if not buying right is the first issue or the most prominent issue, number 2 would be, what would number 2 be?
Well, number 2, and again, they're not in a specific order, but number 2 that I have for today's show is not rehabbing right, because I think part of not buying right is not rehabbing right. So let's just say that, Darren, you're going to go out and you're going to buy, and it doesn't matter what it is. Let's just say it's an apartment complex or a retail strip center, and let's just say that you're looking for something that's value add as an opportunity. Well, you need to make sure that you rehab this property in order to achieve what's in your business plan. So as an example, if you're going to buy an apartment complex or a retail strip center, and there's 30-40% vacancy, and it's tired, and it has old signage, and it needs a coat of paint, and the parking lot is falling apart, and the interiors are not in good shape for apartments. The curb appeal is not good on the retail strip center. Well, you need to make sure that if you want to attain the rents that you want to get in the future, you need to make sure that the property looks how it's supposed to be. So in other words, let's just not throw some lipstick on a pig because it's still a pig. We need to make it a much more beautiful animal, if you will, and lipstick itself isn't just going to achieve that. So in rehabbing right, again, it ties back into buying right, because if you're going to go out and say you think you only need $100,000 in renovation on this property that you're buying, but really you need $500,000 or $700,000 or $1 million to really get where it needs to be, you're going to be way, way, way under rehabbed, and you're not going to be able to buy right, because you're thinking that you might be able to pay more for the property, which you're saying, I'm going to buy this property. I can pay more for this property because I only need $100,000 in rehab. Well, lo and behold, if you find out that you're off by hundreds and hundreds of thousands of dollars, you really can't buy that property at that higher price, you need to buy it at a number that works. So not rehabbing right could be a major mistake. And I actually call this the Goldilocks Rehab. You want to make sure on your Goldilocks Rehab that it's not too little and it's not too much. It's just right. And we think about that story that you and I probably read to our kid. I know I did, and maybe you did too, when our kids were much, much smaller. It's Goldilocks and the Three Bears, and it talked about the porridge when she walks in, and this bowl's too hot, this bowl's too cold, this one's just right. Well, it's the same thing. It's the Goldilocks Rehab, meaning that you got to make sure that you don't over rehab it, because if you do, you may never get those monies back by way of your investment. If you under rehab it, you may never be able to get out of the deal or raise the rents to where you want to. And, of course, as you know, in commercial properties, raise rents, keep your expenses in check, you raise the NOI or the net operating income, you raise the value of the property. Well, if you under rehab it, you may not be able to do that either. So the Goldilocks Rehab says, hey, we got to make sure we rehab this just right. And you got to make sure that if you don't know how to do it, then you need to make sure that you hire, as an example, a general contractor whom you have vetted out, checked references, etc., to make sure that he can get you to the promised land, if you will, by going out, getting all these bids for you, making sure that they are numbers that work for the rehab. And then even on top of that, Darren, and I'm sure you've experienced this, I have too, you got to make sure that you have a little bit of a padding there, and the padding could be as much as 10, 15, 20%, because you may have a cost overrun. And if you have a cost overrun of 10% on $1 million, that's $100,000. Where's the $100,000 going to come from? Do you have to go back to the investors and say, sorry, I was off, give me more money? Well, generally your partners don't like that. So you want to make sure that you bring that overage or that cost overrun or that pad into your rehab budget so that you do rehab right instead of not rehabbing right.
Right. Well, let me ask you, you mentioned the contingency and then also the working with the general contractor. What's your philosophy with, so you've got your investors and you've got your budget and you've got your contingency set at 10 to 20%. And I think from what I'm gathering, you and I are kind of a similar mindset, and that I like to be conservative. If the numbers support 20% contingency, I'm going to make sure that I'm budgeting for that, as opposed to going, under 10. But anyway, my question is this: so if you have your budget and then the contractor has his budget, do you convey to the general that you've got this contingency built in, or is that your numbers and let him present his numbers?
Well, depending on the GC, the general contractor, some of them may even put in their own contingency into their numbers, and some may not. I like to see what they're thinking. In other words, I'm going to tell them, kind of from 30,000 feet, here's what I need to do what I think I need to do to this property, Mr. General Contractor. I think it needs new roofs. I think I need to replace the HVAC, heating, ventilation, and air conditioning systems. I think I need to redo the parking lot, et cetera, something like that. So you're kind of giving him the scope, if you will, of what you think needs to be done. Now, he may agree with that, or he may say, you may need a few other things that I found as well. Or, you may be working off an inspection report from an independent third party who's just making you aware of the things that you might want to think about in the short term and the long term to fix. But the point being is, I usually like to see what they come up with and then compare it to my numbers to see how far apart we are or how close we are. And, I'm no expert at rehabbing. I know something about it, but, if I'm hiring a general contractor, this is somebody who does this all day long, all year long, and I'm trusting that they have the knowledge and the know-how to come in with numbers that should make sense based on the scope that I give them. So to answer your question, I always like to put in a pad whether that general contractor puts one in or not.
No, agreed. I've had the surprise in the first month the contingency got used up, and that makes you kind of like kind of thing there. But thank God I had the contingency because the project came in on budget after all. But let me ask you, so hiring a general as opposed to acting as your own general, do you work as an advisor, consulting with clients on acting as their own GC, or what do you? How do you coach your clients?
Great question, and it comes down to two things for that, Darren. One, does the client have the ability to be his own GC, his own general contractor? Does he have the knowledge and the wherewithal to go out and put that together and find, if you will, basically all the subcontractors? If he's acting as the GC, then he has to find the subs. He has to find at least 3 bids for roofing. He has to find 3 bids for HVAC, 3 bids for painting, 3 bids for make-ready, 3 bids to do the signage, the parking lots, whatever the case may be. So I think you have to have the knowledge to do that. And actually there's 3 things. The second thing would be, do you have the time to do that, even if you have the knowledge? Because that is going to take time. You need to find these people. You need to meet them at the property. You need to follow up with them. And you're going to probably get multiple bids on each of the various categories of things that you need to have done. And then finally is price. Some people want to be the GC because they want to save money. In other words, a general contractor typically is going to go out and get subcontractors. He may have some employees working for him, but typically he will sub a lot of that work out to other folks. And what's going to happen is he's going to orchestrate the whole thing. And he's generally going to put on top of all the numbers a 20 to 30% margin, if you will, for entrepreneurial profit and overhead. So as an example, let's just say that you had $1 million in work that had to be done. If the GC were to price that out, it could conceivably come in at $1.2 million to $1.3 million when you add in his entrepreneurial profit and overhead. Now, if you were to do that and you had the knowledge, you had the wherewithal, you had the ability to do it, you could save yourself in that same scenario a couple $100,000. So it comes down to those 3 things, and you have to decide if can you do it, do you have the time to do it, and are you wanting to do it also to save some money for you and your partners?
Yeah, no, that knowledge piece, I can't stress that enough. I've seen people just make a mess of things, and not just the knowledge. They may have the base knowledge, but the time and to keep the project on a schedule. I mean, you talk about time. It's not just your time, but it's a matter of keeping all of the pieces moving so it all comes together on a reasonable timeline, as opposed to something that lasts way longer and you're not able to collect rents because you haven't got your project up and running.
That's a great point. When you're hiring subs, especially if you're doing it for the first time, they don't know you from Adam. And Darren, maybe you've experienced this, but subs sometimes will start a job and then they'll kind of disappear for a week or two because they're job hopping. Start a job at this location, start a job at that location, start a job at that location, and they're taking their crew and kind of moving from job to job sometimes. Now, what will happen is if you're an experienced general contractor, or if you're an experienced owner-operator that has, quote, the respect, unquote, of these folks, and you're putting money in their pocket time and time again, they're going to try to get the job done in a diligent fashion. However, there is the possibility, if you don't, that you may hire some folks that may job hop, and then what's happening is you have, as you just said, a timeline where you're trying to fill up this property, but first you got to get it rehabbed, then you're going to do the renting and the leasing and the marketing, and then you're going to fill it up. And you could be off by months. And I've had some folks, some clients of mine where that happened, where they thought they were going to have it done by March 1st, and, it's going into June, and they're still not done. So, again, I think it's great if you want to do it and you want to learn and you want to save you and your partners that 20 or 30% entrepreneurial profit and overhead, but do be careful and make sure that you do get a hold of the right people and that they aren't not going to job hop on you.
Yeah. No, I can't say that enough. If you're not confident that you know what you're doing or that you're going to be committed to it, I've just seen it, become a mess. From even like as an insurance agent on some claims that people have elected to go ahead and be their own general contractor, and it's just I've seen people do it successfully, but I've also seen them make a mess of it. So I would tend to agree with you. If you don't have the expertise, hire the general, hire the expert, hire the person who knows. So, all right. So we've talked about not buying right. We talked about not rehabbing right. I like your Goldilocks mention there, because, like you said, you want to do it just right, not over, not under, but just right. What do you look at as what's the next issue for not doing it right?
Well, one of the other things is, if you're not going to be paying cash for the property and the rehab, you're going to have to go out and get financing, as you know, Darren. And when lenders are lending, sometimes the floodgates are open, and it's really, really easy to go out and get money. I had a client once that was talking about in the mid-2000s how easy it was to get financing on apartment complexes. He said it was as easy as putting on your pants in the morning. It was his analogy, And then, 2009 and 10 and 11 came, and it got rather hard to get money. So you have to be careful, in my opinion, to make sure that you get the financing right. So number 3 is not financing right. Don't be lured into 80, 90, 100% financing if you can even find 100% in this market, because beware. You may be working in an economy and in a submarket of a market that's doing quite well today, but what happens if one of those externalities come to bite you on the you-know-where, and your vacancy drops, and then maybe to fill it back up, you need to drop your rents. Well, when you drop your rents, what's happening? You have less income coming in, which means you still have to service that note, meaning you have to pay that monthly mortgage payment, the debt service of principal and interest each and every month. And we saw that here, as well as other parts of the country, where lending was really, really easy, and people were going out and getting 80, 90% loans, not of purchase, but of cost, meaning that they bought a property for $1 million and they had $1 million in rehab, that's $2 million. They could borrow 90%, 80% of the $2 million, not of the $1 million purchase price, but of the cost, which is the purchase price plus the rehab. Yeah. And what happens is, if you don't hit your numbers, and we'll talk about pro forma numbers, which is number 4 coming up in a moment, you don't hit those numbers because there's a shift in the market, because there's loss in jobs, because you have to lower rents to increase your occupancy, then you're going to see an issue trying to make that mortgage payment. So be careful that you don't go out and get financing that's highly levered, because it could, if the market changes, greatly impact you. So what's the suggestion there? Well, maybe go out and get 60 or 70% or 75%, and you have to decide based on the opportunity, based on risk and return, how much money are you going to borrow and how much equity you're going to have. But I think that's one of the lessons learned, and some of the folks that I talked to that have been in the business for years, they said, they've been through the 80s and they've been through the boom, the oil bust rather, as well as the boom here. And they said, back then, I didn't have a lot I either paid cash or I had lower leverage or moderate leverage. Well, maybe those are the lessons learned. Make sure that when you're doing a deal, see if it can work with moderate leverage. Maybe on a smaller deal, if you have a partnership, maybe you can pay cash for the property. Or maybe you can do 70% of the purchase and maybe bring cash from the partners to do the rehab. So you're not relying on the bank as much for all of these monies and being highly leveraged. So number 3 is not financing right.
It's always amazing to me how quickly people forget. Here back in 07 or 06 and a little before that, they were, I know, like in residential loans, they were lending, I think, up to like 125% loan to value, because nobody could see the market turning. They just thought it was up and away. And even now, I mean, in some of the residential stuff, I've seen some of the loan to value ratios start to creep up there closer to 100%. And what's amazing to me is just how quickly people forget, and how easily people they forget. and we'll walk from that. But I'm with you. I feel like if it doesn't cash flow, you need to buy it with some conservative numbers to know that it's going to work. Because if you have a vacancy, if the economy turns and all of a sudden you've got your competitors, your neighbors, or your competition, or that newer product on the marketplace that's a little more attractive, they back off their rent to attract your tenants. It's all a matter of perspective, I guess, and making sure you make sure the numbers work.
Absolutely, and I'm always scouring for opportunities, and I'll even look out of state. Apartments, I believe you need to live within an hour of your apartments. They're very labor intensive, even if you got management in place or a property management company in place. Retail is a little bit different. They're much less labor intensive, and I've identified some properties in Panama City Beach, Florida, that got walloped. In finding there's a bank deal that I'm looking at there. So it's owned by the bank, took it back in foreclosure, and based on my research, I found that they had a $2 million note on the property, which means it probably appraised for about $2.5 million plus or minus. Well, that is a significant chunk of leverage. The market at the time, rents were for retail probably somewhere around $22 to $24 per square foot, plus another $3 for the CAM, because there's triple net rents, meaning that there's a pass-through of the taxes, insurance, and the maintenance onto the tenants, so they pay that by way of additional rent dollars. So if you add all that up, that's $25, $27 per square foot in rent. So this is when the shopping center was built in 2009. They put a couple tenants in, and then they got hit really hard. So I talked about externalities in the market. That happened in Panama City Beach. They had looked at their numbers in financing. They were reasonably highly leveraged, but they thought it was going to work because it was booming and they were building retail, and people were paying $25, $26, $27 a foot. Well, fast forward to today, they're still somewhere at the bottom trying to get out, and the rents have dropped between $12 and $15 per square foot for comparable retail space. They are listing this property now for around $1 million. This property, as I said, appraised probably for around $2.4, $2.5 million with a $2 million note, and now they're trying to sell it at $1 million, and there's still no takers. Why? Because you have to buy right in today's market. What happened to that other owner? Well, obviously there was externalities beyond his control. They overbuilt the area. His rents, for whatever reason, for that submarket fell, and he couldn't make the mortgage payment. So the bank took the property back.
Wow. Well, and that's a story we could tell over and over and over again. And like you said, buying right, finding the opportunity at the right price, as opposed to on the hope that the market will keep doing what it's doing, and not having your contingency and your financing and all that stuff set up properly to weather the storm is just kind of a recipe for disaster, or at least a potential disaster, I guess I'd say. Let's see here. Let's move on here. You've got number 4 down here is not doing the pro forma numbers right. Let's talk about
so
that.
If Darren, if you're going to make a forecast, or you're going to buy a property and you're going to say, hey, I think I can raise these rents. I think I can reduce my vacancy. I think I can lower my expenses. I'm going to make all this money. Well, some folks have made the mistake of being overzealous, if you will, being highly pie in the sky, if you will, meaning they just thought that they were just going to kill it, and they were going to make all this money, and they were going to raise rents incredibly, and they're going to cut those expenses in half, or whatever the case may be. So you got to make sure that when you're forecasting that you have realistic forecasts. Maybe your bumps might be moderate. Maybe they'd be 2, 3, 4% per year in apartments. Maybe the first year or two you may not raise rents at all, and then they'll go up over time. Make sure that you understand the industry averages for expenses. Can you really run that property at $5 a foot, or is it really $6.50 per square foot for expenses? So you got to be realistic on the numbers. There's nothing wrong with doing a forecast or a pro forma where the rents do go up, possibly the expenses do go down, and you do make more money. However, you got to make sure that whatever you are presenting, not only to yourself but to your partners, if you have partners, is to make sure that it's not pie in the sky, that they are pro forma numbers for income and expenses that are realistic, based on the trends in the market, based on the research that you have done. On the flip side of that, some people do forecasts that are so negative that they never buy anything. They say, well, I'm going to have to reduce the rents and the expenses are going to go up. This deal didn't work. Yep, I guess I'm not going to buy that deal either. And what happens is they get into an analysis paralysis where they don't buy anything because they dumb down the numbers so much that the numbers never work on paper because they're so conservative that they don't buy anything. So you want to be realistic. You don't want to be overly aggressive on your numbers when you're doing a pro forma and the forecast of what's going to happen, nor do you want to be super conservative either, because then you never buy anything.
No, that's a point well made. There's a little deal workbook that I've got that I've used, and if you put in realistic numbers, realistic percentages and stuff, I've always been amazed at what the numbers are, but you can get it, overly conservative. You can increase your vacancy percentages. You can increase your expense, estimates for inflation, and then back off your rents, inflation, and you can, like you said, just make yourself scared to death that the deal's not going to work, as opposed to just using historical and what's a conservative, go-forward kind of attitude. I could not agree more with you. And I had a little question I was going to say. Let me ask you, this is something I find that's interesting, is that, sometimes you look at a deal and the numbers that are being presented, when I run them through my kind of analysis, I'm going, how are they, something's not adding up here, right? Or do you ever find that the seller presenting the numbers are not haven't been tested, or they're presenting kind of a rosy picture, or?
I have seen that, and a lot of the sellers that I deal with typically do have real estate brokers, and I think sometimes when they're doing their scenarios that they could be skimping a little bit on the expenses. So as an example, I've seen on that retail strip center I told you about I was looking at in Florida, there was a couple line items of expenses that weren't in there. There wasn't a line for reserves. I mean, there are going to be some capital improvements that you're going to have to make, and you need to have a line item for that, whether that's going to be 20 cents per square foot, 25 cents per square foot. On a retail strip center, you need to have a line item for reserves for apartments. Basically, banks will put in a number of $250 to $300 per unit, but it could be as high as $400, $500, or $600 per unit if you have an older property. So you got to make sure that you check those numbers and make sure that there is a line item for everything they're supposed to be. Property management. Sometimes I don't even see a line item for a property management company. Well, if you're going to self-manage and you're going to do all the things that a property management company does, okay, I can understand why that's not in there. But for underwriting purposes, there should be a line item for a property management company. And they're going to take anywhere from 4 to 6% of the collected income on a monthly basis, sometimes even higher depending on the size of the property.
Right. No, it's... Well, I guess the sum of that is you got to have an understanding of what should be and be able to account for those in order to make a good decision and make sure that your pro forma works, so that if you do hit a rough patch, you've got your numbers are going to still hold true. Let's move on here. We've got number 5, not knowing the market. Let's talk about that.
Sure. The reverse of that is you have to know the market. And I live in Houston, so we'll say we have the universe, if you will, is Houston. Well, we have to drill down because Houston is a big market. I live in the Woodlands, which is a totally different market than the Montrose neighborhood, which is totally different from Pasadena, which is totally different from Clear Lake. I'm sure it's the same for you in Portland, Oregon. You have different submarkets, as they're called, inside of the market. So you have Portland, and then you drill down to the submarket. From the submarket, you can drill down to neighborhoods, because neighborhoods within the submarket, can be different. So you need to really know the market, or in this circumstance, really get your arms around the submarket and the particular neighborhood or neighborhoods that you're in, depending on whether you're looking at office, retail, or apartments. And I think drilling down to neighborhoods are going to get a little more specific, even much more for apartments. But you need to know the market. So one of the mistakes is not knowing the market. Well, how do you fix that? You got to ask lots of questions. You have to ask questions, if you can, of the tenants. You're going to go by a retail strip center, ask them how they're doing, how's business, is business off? And they may not be truthful with that. Well, there's one way to find out. If you have a retail strip center and they have a 90-seat restaurant, and you go in on a Friday or Saturday night, which is typically the busiest nights of the week, and the place is empty, well, it should tell you that something's going on. Maybe he won't be able to continue paying his rent. So you need to understand that. You need to really know the numbers by finding out what the true occupancy is. If you're going to buy a 100-unit apartment complex, are there really only 5 units vacant, or are there 20 units vacant? And ask why that is. Is 20 units vacant out of 100, which is a 20% vacancy rate? Is that typical for the market or atypical? How do you find out? You go to the other apartment complexes in the neighborhood or the submarket and find out if they're running at 5 or 10%, or are they too running at 20%. And then you have to budget accordingly. In other words, can I buy this property right, knowing that I have to run it at, for the time being, a 20% vacancy rate? Can I make money if I know that 20 out of 100 units is vacant? Well, at what price will that work for me? Or you may find out that only the property you're buying is at 20%, but the submarket's at 5%. Well, maybe there's a problem with the person that's running the property. Maybe the sponsor or the owner of the property is not doing a good job. You have to find out what's going on. So know the market, know the submarket, know the neighborhood. What's going on with the economic base? Are there jobs? If you're buying an apartment complex, can they go to work? Because they're probably going to spend anywhere from 20 to 30% of their income on rent. So you got to make sure that there are jobs for them. What's going to happen with the future of employment? What are the trends? You need to understand what's happening. I already talked about occupancy levels, but you need to understand, are rents going up? Are rents sideways? Are rents going down? What's going to happen over the next 3 to 5 years that I hold this property? Drive your competition. If you're going to buy an office building, see what's happening with other office buildings similar to the one you're buying, and make sure it's apples to apples. In other words, don't compare a 1976 office building to a 2012 built office building, because you're comparing a Class C to a Class A, and those two buildings are probably going to achieve much different rents. So make sure you compare apples to apples and understand what's going on. How about new competition? What's being built? Are they going to come in and you own a 5 or 10-year-old office building, and they're coming in and building brand new office buildings at rents that are 20% lower than yours? Are people going to move out? Are they not going to renew on the lease option and move into one of the other buildings adjacent? You need to look at all this. What else? Interview the competition. I tell my clients to go undercover, if you will, and pretend that you're going to be a renter, a potential renter. And you're going to go to different apartments and say, hey, I'd like to rent an apartment here. Can you tell me about the property? And, what are the amenities and what are the rents? That's a great way to see what your competition is doing and learn about what they're doing. Talk to leasing agents. Talk to real estate brokers. Talk to the property management companies. Talk to your mortgage companies, because they talk to all these other people that are in this commercial world, as you and I know it, Darren, and find out what they know and ask lots of questions. Get the research, get the data, and then compile it, and then figure out at what price you're willing to pay for that property. So not knowing the market is number 5 on our list.
No, that know your market. I hear you loud and clear. And one of the things I was going to ask you, do you subscribe to kind of getting in tune with the local government, kind of the plans, if there's any kind of planning going on for, development or zoning or et cetera, as part of that, getting to know the market?
Sure. I make sure that I'm staying in touch with what's happening with zoning laws. I make sure that I subscribe to various research data companies that are out there that'll supply me either data for vacancy, rental rates, occupancy rates, all those things. The more the merrier. And, a lot of this stuff can be free on the internet, and some of this you have to pay for. So you have to decide, obviously, based on your budget, what you're going to pay for and what you're going to get for free. But the more information, the more knowledge that you have about the market, the better you will be, Darren.
No, I agree. That's good. Okay, so we've thus far we've covered, let's see, what was our first one? Our first one was not buying right. 2 was not rehabbing right. 3 was not financing right. 4 was not doing your pro forma numbers right. And number 5 was not knowing the market. And number 6, I've got down here, you have not having the right members on your team.
Exactly.
Who's members?
Sure.
Who are the members?
I always say that real estate investing is a team sport. And I don't know if he knows, Darren, so I still play a lot of competitive amateur baseball. In fact, I have a game tonight. I'm driving into Houston. That's hardball, not softball, and I travel around the world to play. So I love to use these baseball analogies. You've got a baseball team. You've got your star pitchers. You have your catchers, and then you have your infield and your outfield. Well, I'm an outfielder. I don't pitch, I don't catch, I don't play infield. My specialty, for lack of a better term, is I play the outfield. Well, you need to make sure you have the right players on your team when you're going to put together your baseball team or your basketball team or your football team. Well, real estate investing is a team sport. You need to make sure that you have the right players for each of those positions. Now, what do I mean by players on your team? Well, my dad always said that there's 2 guys or gals that you need to have on your team. He said, son, you always need to have a good real estate attorney and a good accountant. The real estate attorney is going to help keep you out of trouble legally with contracts and agreements and all the paperwork that you have to go through, whether you're putting together a partnership or running your business. And a CPA. There's thousands of laws out there. I've never tried to do my own taxes. I've got multiple LLCs and K-1s and different things going on, and I could never ever try to buy that online deal and for $39 and fill out my taxes in 20 minutes and get a refund. I just couldn't do it, and I'm sure you're the same, Darren. But some folks try to do that. Get yourself a good real estate attorney, not just any attorney, but a real estate attorney, one that's specific to what you're doing. Make sure that you get yourself a good CPA that does and has real estate investing clients. How do you find this out? You ask around or ask them when you interview them. Do you do real estate? Yes or no? What kinds of clients do you have that do real estate? How long have you been doing this? How many years have you been in business, et cetera, et cetera. So you need to make sure that you've got yourself on your team a good real estate attorney and a good CPA. Got to have a good bookkeeper. If you're not going to be doing the books, you got to have somebody that does those books for you each and every month, so you keep your finger on the pulse of your business. If you got to get insurance for your commercial properties, you need to call Darren Gross, because Darren Gross is an insurance agent. He does commercial properties. You need to have somebody that does that. You can't hire somebody who is out there doing insurance on houses, because if you're going to go buy that 50,000 square foot office building or storage units or retail or whatever the case may be, you got to have the right insurance broker. You like how I plugged you there, Darren?
Yeah, I was going to say thank you very much. Keep going.
Next I want to plug me. You may need a real estate consultant. This is what I do. I've advised hundreds of clients over the years and brokered numerous opportunities. I've been in the business going on, it'll be 29 years in May. So, I've been there and done that. So I have those services available to people. You need somebody in your corner who can advise you and consult you in your real estate. And, of course, you need other folks like your property management company. You need the right vendors for buying your carpet, your paint, to do signage, materials, lighting, roofing, etc. You got to have the right softwares. Whether you're going to need a property management software, you're going to need an accounting software like QuickBooks or something else that's out there, Peachtree. All of these players have to be on your team. So you need to make sure that you understand that real estate investing is a team sport, and make sure that you do have the right members on your team so that you do not make that mistake, which is number 6, of not having the right members on your team.
I love your number 6 there, the team. And the only thing I was going to say, just as far as kind of what I've seen there, is a lot of times the deals may come up in kind of rapid fashion. And if what I've seen is people that don't have a team are trying to, at the 11th hour, establish the team, and may not get the benefit of the doubt of whether it be, like in my case, an insurance underwriter, agreeing to whatever you've got, or being able to perform as you need, or a lender being able to come together with your loan package or whatever it is. And I couldn't agree more in having some sort of a team. You've got your vetted, trusted professionals that can act on your behalf at a moment's notice and know what you're doing and can help you. I think that's an excellent point. Excellent point. It seems like the time is just flown by. I was just looking here. We just got about 3 minutes left here before we have to bring this thing to a close here. Is there anything in the 6 points that we discussed that you wanted to, or any thoughts that came to mind that we didn't talk about that you'd like to reemphasize?
I don't think so. I think we've covered everything, and I'm sure I could find more mistakes that you and I can talk about, Darren, and maybe we can do that in another show and call it the next 6 mistakes. But I think these are the biggies, and I think if you get your arms around these 6 and understand what they are and address them as they come and try to mitigate them as much as you can, I think you've got 80-90% of the battle right there.
No, I would agree, and I would like to extend the invitation to do this again. I've had a good time, and I've enjoyed discussing commercial real estate with you, and I think the audience will benefit tremendously from this as well. So we'll have to get this on the calendar again. And before we wrap this up, I did want to make certain the listeners understand that David is providing a free 30-minute consultation. And David, do you want to give the listeners a little bit more about what you're offering?
Sure. I have a website that you can go check out. It's realestateadvisor.com, and I'm offering a free 30-minute consultation to help assess your needs and see if I can help you achieve your goals when you're looking to go out and buy those commercial properties. I do consulting on a national basis, so no matter where you are, I can help you with that retail building, that apartment project, etc. So all you need to do is visit realestateadvisor.com, click on the contact page, and just send me an email and say that you heard me here on this show, the Commercial Real Estate Pro Network with Darren Gross, and you'll get that free consultation. Secondly, you can also check out, if you're ever interested in partnerships and you're looking to be perhaps a hands-off investor, you can also go to realtyincomeshares.com and do the same thing, hit the contact button, and shoot me an email.
Hey, David, that's great. So again, for the listeners, therealestateadvisor.com or realtyincomeshares.com. We've just got a few seconds here to wrap this up. But David, I want to thank you again for taking some time to talk with us today. And again, I'll be back in touch with you, and we'll do this again soon.
My pleasure, Darren. Thanks for having me.
All right. For our listeners, just want to remind you that you can find us. Clearly, you've found us already. So what we'd ask for you to do is to like, follow, share, comment, all of those social networking things so that others can find us as well. And please leave a comment. We'd love to hear from you. Spread the word about Commercial Real Estate Pro Network and CREPN Radio. Until next time, we want to say again, thanks for listening to Commercial Real Estate Pro Network and CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.